market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. It's been a big markets week, so joining us now, Mohit Mittal, Chief Investment Officer of Core Strategies at PIMCO. Mohit, as always, thank you so much for joining us, especially on a week where there's so much expectations fluctuating about what the Fed does next and how many cuts we'll get. Do you believe markets are getting ahead of themselves?
I think there is a lot of data that is still coming. I think tomorrow or the Friday's jobs data would be very essential for the Fed. I think our view would be that likely scenario, Fed delivers a 25 basis points cut. But in a scenario where the jobs data continue to show weakness, there's a good case to be made for a 50 basis points cut. If I just take a step back and think in a little bit longer term horizon, I think what you observe is an economy that is transitioning from what we would call a post-pandemic sugar rush to a pre-pandemic trend growth. And that pre-pandemic trend growth is give or take 1.5% real growth plus 2-point-something% inflation. And in that backdrop, 5.5% Fed funds rate is quite restrictive. So it makes sense for the Fed to cut rate at a moderate pace. The challenge would be at too aggressive a pace of rate cuts could shift the balance on risks of inflation towards the upside. So moderate pace of rate cuts is prudent. So
basically your base case is that inflation is doing okay, and so the central bank, the Fed, can now go to its second mandate, which is growth. What's the probability of not getting a soft landing?
Yeah, so I think a likely scenario, as I mentioned, is like this shift from a post-pandemic sugar rush to a pre-pandemic trend growth, which is closer to 1.5% real and a 2-point-something% inflation. There's certainly a scenario where growth is below that. I think we would assign a little bit of a lower probability to that based upon current data. When you look at the current data from a consumer point of view, from corporate earnings, from bank earnings, it's pointing towards that scenario. But of course, we have to be open-minded about the uncertainty around data, particularly after recognizing that the Fed funds rate have been in the restrictive territory for about a year and a half now.
So how many cuts are you expecting from the Fed? And I know we also heard from Howard Marks saying, look, then they're going to be stuck around 3 to 4%. Is that right?
I think the neutral rate closer to 3% on Fed funds is reasonable. I think, pre-COVID, the neutral rate was much lower. I think certainly it has moved up a little bit, but it has not gotten to a level that it was pre-financial crisis. Right. Pre-financial crisis, you recall, the neutral rate was closer to 4%. So we would be in that camp of a neutral rate on Fed funds in the next couple of years being closer to 3%.
So where do you see actually Treasury yields ending up? And so where do you see opportunities in the market?
Yeah, so again, I think if I take a step back, what you observe is a fixed income market that looks quite attractive. Yeah. When I was on your show in April, we talked about kind of value having been re-emerged in the fixed income markets. Recall, in the Q1 of this year, early Q2, 10-year had sold off to about 4.7%. Certainly, you've seen some repricing. But even if we look at valuations today, they look very attractive for the long term. You have starting yields closer to 5.5% on high-quality fixed income. And then you say that in many states of the world, you can realize that. And then the other important thing that has happened is the inverse correlation of equities versus stocks. Right. So from that point of view, fixed income makes a lot of sense in an asset allocation sense, because in periods, for example, what you saw in first week of August when you had -5, -6% equity returns, fixed income did quite well. So there's value in fixed income from a diversification versus equities, and then also a yield enhancement versus cash. So certainly, I think on a longer-term basis, fixed income looks quite attractive here.
But overall, I mean, the PIMCO favors buying bonds outside of the U.S. Is that fair? And is that because of the differential with other countries?
I think we do find good opportunities outside of the U.S. I think UK looks quite interesting from our point of view. When you look at 10-year UK gilts, give or take, 4%, 30-year 4.4, 4.5%. UK, from our point of view, is an economy that probably has a trend growth of near 1% in the next 1 to 2 years. Inflation is moving towards 2%. And then the fiscal picture is different in UK relative to that of the US. In the US, we are running closer to 5 to 6%, maybe 6 to 7% deficits. In UK, we are closer to 2 to 3% deficits. Right. So given kind of lower fiscal impulse in the UK relative to the US, lower growth trajectory, and then valuations where they are, UK certainly looks interesting. When we go beyond UK, like Australia would be another market that looks interesting.
Mohit, I mean, if you look at rates volatility in the US, they've definitely been overshooting other regions. Do you expect that to continue?
I think with respect to rates volatility, I think the U.S., the thing is that U.S. Treasury market is a very high quality duration asset. So in any kind of risk-off environment, U.S. Treasuries would do much better than many other countries, even UK and Australia included. Yeah. So you can kind of see that that is happening in the last couple of months as well. So that volatility is elevated because it is acting as that risk-off hedge. But then the other side of it also is that growth, while slowing down, is not kind of going into a recessionary territory. So if you have a data, like for example, if next week or later this week or next week you see some recovery in data, you could see some movement in the US rates as well.
And just going back to the UK, I mean, you laid out basically the investment, business case for the UK. We hear a lot of negativity from Labour about how much they have to do in the budget, about how worried they are that they don't have enough money, blaming it firmly on the previous government. Is there a worry that actually the gilt market gets shocked on October 30th when the budget comes out?
I mean, I think there is certainly a possibility, but I think there has been a clear kind of lessons learned, and you can see kind of acceptance of the lessons learned. So, certainly possible that that kind of event gets repeated, what you saw in September 2022, but I would assign a lower probability to that. I would still think that the deficit picture in UK would be in the 2.5–3% range, and that makes a reasonable case for having UK gilts in the portfolio.
The Bank of England could probably be less dovish, I guess, than other central banks because the economy is stronger, right? Overall, what are you expecting for quantitative tightening? I mean, this is huge, that program, and actually a lot of people don't often talk about it.
Yeah, so I think even if I kind of think about a Bank of England in a little bit of a broader sense, what you see is, like in the likely scenario this month, you could see a Fed cut rates 25 to 50 basis points. You could see ECB do another cut. But there's a chance that Bank of England does not deliver a rate cut this year. They continue, but by December they start to deliver another rate cut. So if I take a kind of a 1 year horizon or 1.5 year horizon, I could see Bank of England move rates from give or take 5% currently to about 3.5% in the next 12 to 18 months.
France, oh la la. They're not. Do you worry? I know that they have high debt costs. Yeah. They're going to probably stay. We don't know what happens in the budget, and they still don't have a prime minister.
Yeah. So I think, look, France. You saw, when Macron first announced the election a couple of months ago, you saw meaningful weakness in French government bonds. Oats at that time widened to almost 85 to 90 basis points over bonds. And that was a good opportunity to add exposures. Since then, we have what we have seen is oats recover towards almost 70 basis points over bonds. That to us looks a little bit fairish, given kind of the uncertainties, as you pointed out as well, with respect to Prime Minister. So from an investor point of view, in the French government bond market, we would say looks fairish. But if there is volatility, we recognize, it's going to be temporary. So if you see a reversal back towards 90 or 100 basis points over bonds, it's certainly going to be an opportunity to add exposures again.
But in Mohit's world, I mean, when the markets go crazy, but bonds behave in the way they should be, is there a sign of relief? Do you actually look at it and say, like, oh, finally, we're back?
Well, I think we've always maintained that thesis. There's a very, strong value in having bonds in the portfolio. Yeah. I think what happened in 2022, like when you saw meaningful kind of move rate higher in rates, people started to question the correlation properties. Yeah. And I think what that misses was the idea that correlation has always been a function of inflation. Okay. When inflation is high, then fixed income is no longer going to be as attractive a hedge. But now there's a pretty substantial evidence that inflation is firmly in the 2-point-something territory. Like with what we are seeing in the commodity markets, that should further support inflation moving in the 2-point-something territory. The weakness in the growth data again supports inflation in the 2-point-something category. And in that environment, when you can lock in 5.5% to 6% yields in high-quality fixed income for 6 to 8 years, it's a really good value.
Mohit, thank you so much, as always, for joining us. That was Mohit Mittal, Chief Investment Officer of Core Strategies at PIMCO. Now, I also want to bring you a Bloomberg scoop. Now, police in China are said to have detained 5 current and former employees of the British drug maker AstraZeneca. Now, that story came out about 20 minutes ago. They're being questioned about potential illegal activities to do with the company's collection of patient data. Now, sources say the individuals being held are all Chinese citizens who marketed cancer drugs in AstraZeneca's oncology division. So we'll, of course, keep a very close eye on this developing story. Coming up, OPEC Plus considers delaying a planned boost in oil production. We discuss the factors prompting a rethink amongst members next, and this is Bloomberg. Well, time for a commodities check. Iron ore slumping to its lowest level since 2022 amid concerns over China's recovery. Meanwhile, OPEC Plus is close to agreement on delaying a planned boost in oil production after prices plunged on fragile demand. Now, in a moment, we'll be speaking to Seema Shah from Principal Asset Management. But first, joining us is Will Kennedy, Bloomberg Senior Executive Editor for Energy and Commodities. So thank you, Seema. I'm looking forward to our conversation on crazy markets. Commodities a little bit less crazy, Will.
This morning, but it's been an eventful week, and the common theme between iron ore and I think oil and to some extent copper as well is that while there are particular things going on in each of those markets, people are very concerned about the strength of the Chinese economy, and I think they've got back from summer and they're seeing a lot of weakness, and that's really putting pressure across all of the commodities sector.
I mean, oil, today I'm looking at the chart, is actually pausing, near this 14-month low. But are there real concerns that oil could be the first indicator of almost like a global slowdown?
Yes, China, I think, is very much in focus, but we've got lots of things going on the supply side as well. The market's also been focused on the prospect for more OPEC oil into the market. And, of course, there's a lot of focus on discussions that we've been reporting over the last couple of days that OPEC may, in fact, decide to pause on that output increase. And we're waiting today for details of how long they pause and how much oil that they hold back. And that will be key to tracking how the market develops over the next couple of weeks.
I mean, we're also tracking this Libya production as there's this tussle between rival Eastern and Western government threatened supply. Is it surprising that geopolitics haven't really impacted the oil price that much?
Well, I think Libya is important because Libya, in contrast to the crisis in the wider Middle East, has actually taken barrels off the market. We've seen probably 500,000 barrels that were coming into the market off the market. I think this week, one of the reasons we went lower is that the central bank governor who Bloomberg interviewed indicated that a solution to the political issues in Libya might be closer at hand than people thought, and that renewed downward pressure. If those barrels did come back quickly, it would add to the bearish mood in the market.
Will, thank you so much. Will Kennedy there, who oversees all of our commodities and oil coverage. Now, joining us now is Seema Shah, Chief Global Strategist at Principal Asset Management. Seema, thank you for coming on to put all of this into context. We have a lot of stories that then you wake up on Monday and you see the markets literally fall out of bed and you kind of wonder, what is this, like an economic ugliness about to take over, or is it just market jitters and valuations?
I think there are real questions about the strength of the U.S. economy. You look across a number of indicators, all pointing at an economic slowdown. And I think the question that the market is grappling with at the moment, and of course affected by seasonals because everyone expects September to be a terrible month, is they're looking at it and say, does slowdown necessarily mean recession? Yeah. And can the Fed come in and really provide that kind of defensive nature that the U.S. economy probably does need at this stage?
But see, we haven't really seen a correction. We have these, big sell-offs, and then they go back up markets to where they were. So are they too optimistic about the way forward for the U.S. economy?
I don't think they are, actually. I mean, we're definitely in this soft landing camp. I think like all other analysts out there, since the July jobs report came out, we've gone back through all the economic data, did all the analysis. And we're still of the mindset that, yes, slowing activity is currently the theme. You can see that across the labour market. You can see that across consumers as well. But there is nothing so intrinsically broken about the US economy compared to, say, 2007 that policy stimulus can't fix. So we do believe that, let's say that the Fed stepped back and let the economy just move along as it was expected to, then recession would likely be on the cards at some point. But we know that the Fed is willing to step in. So we actually are fairly confident that the US economy can do OK.
So you're also confident that inflation doesn't really pick up from here, because worst case scenario is, of course, higher inflation, slowing economy.
I think that's one of the risks which is actually priced, or at least underestimated. You don't really see people talking about the inflation numbers anymore. I mean, even when the PCE number came out last week, no one really takes much notice. So I think at this stage, when we look at the components of inflation, we don't have too many concerns that it's going to come back. I do think, though, that once the Fed does start to cut rates, let's say move by a 50 basis point, another one in November, it's not our central scenario. But if that does happen, and you see mortgage applications increase fairly significantly, we could potentially be back to that overheating moment early next year, in which case inflation does become a problem again.
So is it tricky for the Fed to navigate? Will they be worried about doing too much or too little?
I think at this stage, I think they're a little bit more worried about doing too little. Certainly that's the theme that you're getting from Chair Powell. But I do think they're going to be cautious. When we look across, again, the historic data, it's rare for the Fed to cut rates the first time by 50 basis points. Typically, the labour market is much, much weaker than it is today. So I would say that they're going to move somewhat cautiously, but of course, so much depends on tomorrow's report.
Seema, I know we were talking about China. I mean, it just feels like we have pretty discouraging or worrying news, but nothing really is priced in a meaningful way. I mean, away from the U.S. and Fed moves, is there anything else you worry about?
Well, I think the key thing is that global growth is a little bit lackluster. There's nothing particularly impressive out there. So one of the concerns is that, again, you look back at previous downturns, and there's always been one very strong side of the global economy that can come in and really lift growth and have those positive effects around the world. You're not really seeing that because China's kind of stepped out of the show. Europe is very disappointing, I'd say. I think there was a moment of hope earlier this year, and that really hasn't come through. And actually, ironically, it's the UK, which actually looks like the market which has got a bit more, staying power. So I think there are serious concerns, not enough at this stage to trigger a massive pullback, because we know central bankers are going to come in size potentially, but enough to probably bring down expectations for what we can expect from returns from risk assets.
Seema, thank you so much. Seema Shah from Principal Asset Management stays with us, and we'll talk a little bit more about the UK and also Europe. Plenty more analysis, and this is Bloomberg. Welcome back, everyone. Now, still with me, Seema Shah, Chief Global Strategist at Principal Asset Management. Seema, we're having a great conversation about some of what you're watching out for in the Fed, and of course the jobs data is the big one on Friday. Now, this morning, J.P. Morgan scrapped some of their bullish calls on China because of risks around the trade war. Are you changing any of your calls around that?
So we've been quite underweight China for a while. I know there was a moment probably early in about February where we did sit back and think, right, are we getting this wrong? Because there's so much bad news and pessimism priced in for China that could you get a slight upturn? And of course, the market did do well for a month or two, but it's run out of steam again. And I do think that the US election and everything around it is going to continue or to restart weighing on China. And there's not that much good news coming out from them. The policy stimulus isn't there. Probably not enough to offset the additional negativity which is likely to come from the US election.
You're right. I mean, we haven't really had that bazooka policy support that many market participants were expecting. But are we going to see more of a rhetoric against China as we get into the US election that actually translates into lower economic growth?
I think we will. So we know that the agenda against China is bipartisan, so you're going to hear it from both sides of the camp. And that's going to be a key narrative, which also has a lot of support across the voting public. So this negative sentiment of what could happen to China, what's going to happen to the various sectors, is likely to continue weighing on them. I think the one factor that we do step back and have a little bit of hesitation is that valuations are already very cheap. It's quite a struggle to find anyone out there who is positive about China. So if there are any kind of upside surprises, and let's say the government does come in and recognize that there is going to be some additional negative impact on China's economy from the rhetoric and from the potential tariffs, that then they get a bazooka moment. That's potential, but at this stage, and listening to the way that they talk, they're in here for the long term. It's very unlikely that you're going to see a very, very significant stimulus package that would offset what's coming from the tariff side.
Seema, thank you so much for joining us. Seema Shah, their Chief Global Strategist at Principal Asset Management. Coming up, we also turn our attention to emerging markets. Goldman Sachs telling us why the macro looks good, but the politics is risky overall. For example, oil actually steadying near the lowest close since June 2023. Again, we had an industry report this morning pointing to a big draw in U.S. crude stockpiles, with the market taking a breather following a sharp sell-off this week. We'll have plenty more on markets next, and this is Bloomberg. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. These are your top stories. Treasuries get a jolt from soft U.S. jobs data, further supporting the case for a supersized Fed cut. Japanese real wages rise for a second consecutive month, keeping the BOJ on track for another potential rate hike later this year. Plus, Kamala Harris breaks with Joe Biden on tax rates. The U.S. Democratic nominee says those earning $1 million or more should pay 28% on capital gains. So, as we were just saying, U.S. presidential nominee Kamala Harris wants to raise capital gains tax on people earning $1 million or more. So, speaking at a campaign event in New Hampshire, the Democratic candidate said America's wealthiest should pay their fair share.
If you earn $1 million a year or more, the tax rate on your long-term capital gains will be 28% under my plan, because we know when the government encourages investment, it leads to broad-based economic growth and it creates jobs, which makes our economy stronger.
Well, we're now joined by our anchor, Kriti Gupta, who's been following, of course, the campaigning from very close. Kriti, thank you for joining us. When you look at what Kamala Harris is trying to do, I mean, she's basically saying, I'll look after a lot of people, especially, you know, the less rich Americans. Does that put her in an awkward position in going against Donald Trump?
It has almost a advantageous position, some would argue, Francine, when it comes to kind of the pushback that she's getting in some of her other economic policies, including things like price gouging, addressing issues in grocery prices, in Medicare prices, in housing prices, even something that economists are looking at saying, well, would this create stagnation in the U.S. economy? This seems to be her response to that, where she's talking about a 28% capital gains tax. To your point, really talking about the industry and really talking about how this could actually help businesses. By comparison, you're seeing the graphic on your screen right now. Joe Biden proposed as high of 45%. And of course, Donald Trump is still proposing tax cuts on this. So you are starting to see this become kind of a little bit of a concession here in really trying to get the business community on her side, all subject to the passage of this in Congress, of course.
So she's trying to basically convince voters to trust her on the economy. Is it working?
That is exactly the perfect way to put it. It's not working just yet, but what it is doing is showing that her policy could be different from Joe Biden's. And where he's really getting a lot of the criticism in his current term is that a lot of the gains are really coming more driven by the Federal Reserve rather than something he's done in terms of adding more jobs. The concern is Kamala Harris is going to be simply status quo. And to your point, she's pushing back on that she's going to be far more than that.
Kriti, I know, you know, among some of her proposals, and again, there are more that will be coming. Some of the proposed measures will include cutting some of the red tape for startups. What do we know about takeovers?
Well, we know that she's going to be tough on tech. That's something that's bipartisan on both sides. But we also know that she's commented on one particular deal that's really causing a lot of commotion over in the States, and that is the proposed deal from Nippon Steel to U.S. Steel. And this is important because U.S. Steel, even though is a major kind of a smaller company, not really even traded in the major indices, is actually a landmark company for the United States back in its heyday, back in 1916, when the U.S. manufacturing sector was rocking and rolling. But Francine, since then, it has been bleeding employees, bleeding growth, even bleeding steel production. The problem is that this is still one of the key companies for the U.S. manufacturing sector that both Kamala Harris and Donald Trump and obviously Joe Biden, you are seeing bipartisan support that this is a deal that cannot go through. U.S. Steel has said that if this deal is blocked, as the Washington Post has reported Joe Biden will try to do, they will have to close down some of their steel manufacturing. That is not going to play well into a lot of the employees, specifically in the Rust Belt and specifically in the demographic that both Donald Trump and Kamala Harris are trying to appeal to.
Kriti, thanks so much. Kriti Gupta there with the very latest on the U.S. election campaigning. Now, political risk and the potential for higher tariffs if Donald Trump returns to the White House is, of course, casting a long shadow over emerging markets. That's the view of Goldman Sachs, who says the macro outlook for EM is good, but warns that developing economies have more to lose in a global trade war. Let's discuss all of this with Kevin Daly, co-head of economics for Central and Eastern Europe, Middle East and Africa at Goldman Sachs. Kevin, as always, thank you so much for joining us.
Love to see you, Francine.
This is a great report. It's comprehensive. It goes through emerging markets. You see some upside for emerging markets, but again, they're caught, I guess, between dollar and whatever dollar does, and the fortunes of China, which is linked to the U.S. election.
So, I mean, let's start from the macro first. I mean, the macro outlook for EMs has actually been pretty impressive. I mean, growth at the moment is currently tracking around 4% annualized on our metrics. I mean, that's much higher than we have for DM growth, which is around 1% or even less annualized. We're talking about recession risk and a lot of DMs. On inflation has fallen faster than it has done in DM economies from the peaks early last year. The gap between inflation in EM and DM economies is now close to a record all-time low. External balances since the pandemic in EM economies have improved pretty significantly. And if you're to identify countries where external balances look fragile, it's more often going to be DM economies rather than EM. So the problem, with EMs this year and for the last 18 months has not been the macro. The macro performance has been very good.
So what is the problem going forward? I guess in certain cases it could be political stability, but also if China really does worse, they're going to be affected, right?
A lot of it this year has been the external risk. So we saw that in the first half of the year when you had the hawkish repricing of Fed policy. That put a lot of EM assets under stress. And now as we're heading into the second half of the year, of course, the prospect with, there's all eyes are on the US elections, the uncertainties around that. The tariff proposals by former President Trump, would, in all likelihood, if they are implemented, trigger retaliatory actions. In a global trade war, it is important to emphasize that everyone is a loser, including the US in that scenario. But the economies that would lose more than most are export-orientated economies, and emerging markets tend to be, their growth model relies on export growth. So for countries like China, but also across EM more generally, that is a major risk that we need to monitor.
But Kevin, if you look at some of the emerging markets, how closely tied are they with China? So China, again, it could suffer really from trade and tariffs. We've also seen some pretty tepid policy from authorities in China to deal with this downward trend of the economy.
Yeah, so China, China is there is clearly some weakness there. We think some of that, we think in Q3 will be relatively weak. We think actually there'll be a recovery in growth in Q4. On the policy front, there's been significant issuance, which implies that actually there is some fiscal firepower there potentially for more stimulus on the fiscal side going forward. Our forecast for China growth this year is around 4.9%. So it's it is weak. It's weaker than it has been in the past. It's not a disaster, though. I think some of the the performance, some of the pessimism around China is sometimes overstated. But more than that, actually, you're seeing outside of China. You see, if you look at other Asia EM economies continue to grow very strongly. India in particular, but not just India. You see across a lot of emerging markets in this time zone are performing relatively well. Even LATAM. LATAM over the last year has been the weakest performing area of emerging markets, but some of those economies are showing signs of improvement as well. So it's not just a story about China.
So, Kevin, what are some of your recommended trades and conviction views? So let's start with equities, maybe.
Yeah. Well, EM equity valuations are very heavily discounted. So from a longer term perspective, we are very positive on EM equities. From a shorter term trigger, in an environment where if you have Fed easing in a non-recessionary Fed easing, which is our central case, we think recessionary risk in the US is exaggerated.
So moderated easing, I guess.
So moderate, yeah. I think the bar to a 50 basis point cut is actually relatively low. But if there's a sense that they're fall behind the curve, I think there could be more risk presented by that. But if you have non-recessionary easing from the Fed, that is a sweet spot for EM assets. I think equities would do well in that environment. We also think that fixed income in particular would do well in that environment. We like Mexico, we like Poland, we like Korea, fixed income, and I think EM currencies as well. So, we are relatively constructive on most EM assets going forward, but fixed income in particular.
When you look at currencies, what happens to dollar actually in your scenario? Because that will move things around.
Yeah, so in a sort of moderate non-recessionary easing environment, we have moderate depreciation in the dollar. It's tricky in the sense that if you have a risk-off sell-off, the Fed needs to walk a pretty fine line on this and needs to gauge this very carefully. But if you have a severe risk-off environment, then EM assets will tend to do badly in that environment. And counterintuitively, even though it would be bad for the US economy, the dollar would probably do well in such an environment. But in the moderate, non-recessionary Fed easing that we expect the dollar to weaken somewhat and EM currencies to do well against it.
So, but that could change on Friday with the jobs report.
Yeah, in the jobs report, as I say, we're actually a little bit. Our US team is a little bit below consensus on NFP. We think the bar to 50 basis point move is relatively low, but our central case remains 25 at least for now. So, yeah, it is definitely all to play for tomorrow.
Thank you so much, Kevin Daly there from Goldman Sachs with very latest on some of the emerging market plays. Now, coming up, military cooperation and $50 billion in financial support. China goes all in on strengthening ties with Africa. We'll get more on that story next. And this is Bloomberg. Well, China's President Xi Jinping has vowed to provide Africa with $50 billion in financial support over the next 3 years and strengthen military cooperation in a sweeping effort to deepen China's relations with the continent.
After hard work in the 1970s, China-Africa relations are now at their best period in history. I propose to elevate the bilateral relations between China and all African countries that have diplomatic relations with China to the level of strategic relations.
Let's get straight to Bloomberg's Ondiro Ganga, who's in Kigali for us. Ondiro, so what were the key highlights from President Xi's speech?
Thank you, Francine. So this was a highly anticipated speech, and you can tell by the number of African leaders that attended, there were greater expectations going into it. For a long time, this summit has been Christmas, and President Xi has been center, granting every wish that they bring on board. However, this time around, his checkbook was a little bit tight. Africa only got $50 billion over the next 3 years, and this means that $30 billion goes into credit line, another $10 to $11 billion goes into various assistance, and another $10 billion Chinese companies investing in the African continent. And this just signals the end of an era. Those days of mega infrastructure project with massive funding from China are over. Now it's a new phase, which President Xi Jinping terms as an era of small but beautiful projects. So now every coin that comes into the African continent from China will be well thought through, and it has to have greater benefits to China. Take an example, the Tazara railway line that they want to resuscitate going to the East Coast. First of all, it counters America's project, the Lobito corridor in the West Coast. And second, it allows them guaranteed access to critical minerals for their EV market back at home.
Ondiro, how are African governments then likely to reconcile this with the new reality of reduced funding from China?
Currently, they're not, and it's going to be a long road and a long walk for them, because take a look at President William Ruto. He was going to China with the hopes of securing funding to expand the SGR project, one of China's big projects in Africa that ended up being botched. And now we're seeing that China is walking back its financing. This is a continent that has a couple of problems. China has always been the alternative source of funding. And now in a season where they're struggling with raising revenues, budget deficits are high, and also they're in debt distress, it's going to get really tough before it gets easier. China has already laid out its plan for Africa. Now it's time for Africa to go back to the drawing board and lay a plan for Africa, unless it's going to get tougher before it gets easier, because money from the World Bank and IMF comes with conditionalities that have caused social and economic tension across Africa.
Ondiro, thank you so much. Ondiro Oganga there with the very latest, of course, on China and Africa. Now we'll have more on China's relationship with Africa in this month's edition of Africa Amplified, and that comes out tomorrow, 5:30 a.m. London time. Coming up, tumbling sales and profits, and now it's been relegated from the FTSE 100. More on Burberry's troubles next. This is Bloomberg.
I was also on record as saying that change would be a good thing from a government point of view. We all needed certainty and stability, so a two-term government would be a good thing, not a bad thing. I think from UK PLC, where financial services I think is genuinely important, we just need some stability around tax, whether that's personal or corporate, and we need a competitive lens on our regulatory framework. So yes, we've got to regulate well, but we've got to ensure that we're an attractive proposition for businesses for a number of different reasons. So we'll be vocal in saying that. It's not our job to set policy, but we will be vocal in making those points.
How does that affect, though, not just you, but the reinsurers you work with as well? If we're talking about this very strong kind of commercial underwriting trend, doesn't that kind of take a big chunk out of that?
We've got to be very careful. So 80% of our business is non-UK derived, so most of it is international.
But you're having the same risk in the US, no?
Correct. So if you look at the world at large, 70 of the countries in which we trade will have been through elections in the 12-month period that we're talking about, 60% of the world's population. Ironically, I know this sounds odd in the context of the question, we probably feel more stable here than we do in many other places. When you look into Europe, you look at the uncertainty in France, in Germany, what does that really mean for Europe? In the US as well, we've got the elections coming up, what does that mean? So oddly, we probably feel more comfortable in understanding the direction for the UK at the moment than almost anywhere else.
Well, that was John Neal, Chief Executive Officer of Lloyd's of London, speaking to us a little bit earlier on with Kriti Gupta. Now, to some other stories making news, and Bloomberg understands that the UK is to make further changes to water company insolvency laws as fears grow that debt-laden Thames Water will run out of money next year. Now, it's the first time that the new government has hinted that special administration, a form of temporary nationalisation, is an increasing possibility for Thames. Now, the company, which supplies water to 16 million people in and around London, is seen by the government as too big to fail. NVIDIA says it is in contact with the U.S. Justice Department but has not been subpoenaed over an antitrust investigation. The DOJ often sends requests for information in the form of what's known as a civil investigative demand, which is commonly referred to as a subpoena. Well, Bloomberg understands that the Justice Department has sent such a request seeking information about NVIDIA's acquisition of Run AI and aspects of its chip business. The picture for NVIDIA pre-market, you can see gaining some 0.9%. Now, HPE shares fell in extended trading after the company reported weaker than expected margins. Its adjusted gross margins stood at just under 32% in the fiscal third quarter, marking a decline from a year ago. Now, this suggests that lower than anticipated profitability in its closely watched AI server business. On to other corporate stories, and UK luxury brand Burberry is to drop out of the FTSE 100 later this month, with insurer Hiscox taking its place. Now, Burberry is being relegated after its market cap fell by a third over the past 3 months as consumers continue to tighten their belts. Well, we're now joined by Angelina Rasquet, our European luxury retail reporter. Angelina, thank you so much for joining us. Burberry has had a tough time, partly because people are spending less, partly they probably don't have the right product mix that the wealthy want to buy.
Indeed, Francine, that's been the story of Burberry. I mean, basically, after the pandemic, we saw boom years in luxury. All the luxury brands were selling a lot as people were getting out of their houses. But in the past, in the recent months, we've seen that Burberry has really struggled. It's in turnaround mode. It was trying to elevate the brand to make it more exclusive in the eyes of the consumer under the previous CEO, Jonathan Akeroyd. They also hiked prices. And that strategy hasn't really delivered. So in July, they got rid of him and they named a new CEO.
So if you look at the new CEO, what are some of his big challenges?
Indeed, so his name is Joshua Schulman. He's American, and he was previously at Michael Kors, which is considered to be an affordable luxury brand. So obviously, the question from investors is that will he sort of slow down this elevation strategy? Will he also try to bring Burberry into the affordable luxury category? So we'll find out more from him in November when he presents his vision for the brand for the 6-month earnings of Burberry. The question mark also for Joshua Schulman is, will he get along with Daniel Lee? Daniel Lee is the designer that's been at Burberry for the past 2 years. He was named under the previous CEO. And typically, when a new fashion CEO is named, he or she, they like to appoint their own designer who will translate their commercial vision. So we have to see how that relationship goes on. And there's been a lot of pressure internally to deliver winning design. But obviously, the context has been that maybe Burberry pushed too much into that fashion forward category, and so far it hasn't really been really welcomed by consumers. So these are some of the challenges. I mean, right now, and as you mentioned, it got kicked out of the FTSE 100. So maybe it's from here it's actually. It could be positive because maybe they'll receive less scrutiny from the markets.
So is Burberry unique in its slowdown, or how many more are also struggling?
Generally, I mean, there's been a clear slowdown in demand for luxury goods, but obviously in the luxury space you have different levels of exclusivity. Some brands, such as, if you think about Rolex, Patek Philippe, Hermès, they cater really to the uber wealthy individuals, or Loro Piana at LVMH, and Burberry was situated sort of in the middle. And also, if you're in a turnaround phase like Burberry, but also like Gucci at Kering, it makes it trickier when there's a sharp slowdown. So it's a different picture according to different brands.
Angelina, thank you so much. As always, Angelina Rasquet, their European luxury retail reporter. Up next, we'll have plenty more. Bloomberg Brief with Danny Berger and Manus Krani in New York. The picture firmly on that U.S. data, of course, that we'll look at tomorrow. Markets for the moment a lot more stable than they have been in recent days. STOXX definitely pausing ahead of that U.S. jobs data. Traders looking towards weekly jobless claims due out later today as well. And then the non-farm payrolls is a big one on Friday. We look at yen. We look at dollar treasuries. Little changed after tumbling yesterday on the data showing a slowdown in the U.S. labor market. The dollar holding steady. This is Bloomberg.